Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Cineplex's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Cineplex is an entertainment company that operates 165 movie theaters across Canada. The company is headquartered in Toronto, Ontario, Canada, and was founded in 1999. It went public in 2010 and currently trades on the TSX and the Pink Sheets. We're going to focus on the ticker that trades on the Toronto Stock Exchange, so all the numbers in this video are in Canadian dollars. But if you live in the US and want to invest in this company, the ticker is CPXGF. The company operates theaters under numerous brands: Cineplex Cinemas, Cineplex Odeon, Silver City, Galaxy Cinemas, Cinema City, Famous Players, Scotiabank Theaters, and Cineplex VIP Cinemas. It also owns and operates multiple brands for entertainment, such as Ultra AVX, Xscape Entertainment Center, and Player One Amusement Group. They also own and operate the following restaurants: Outtakes and Poptopia. Cineplex has been proactively cutting costs and raising money due to theater closures from COVID. Let's get started with the model. This is a small cap company, 891 million market cap. They're trading at $14 a share and they have 63 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. They did have strong free cash flow in 2019 at 167 million, but a big negative in 2020 due to COVID. Net income is the profit and loss on the income statement. It's revenue minus expenses, and that's positive every year except 2020. Revenue is a sales for the company, and that was growing nicely until 2020. Their revenue in 2020 was 25% of their revenue from 2019. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue, and the difference is the gross profit. Their gross profit peaked in 2019 at 1.1 billion. It was 300 million in 2020. Below that is operating expenses, and then below that is operating income, and they had a big negative in 2020 due to low sales. Below that is the interest they pay in their debt. You can see in 2020 they paid the most interest because they needed money to run their business, so they took on a lot of debt. Below that is other income and expenses. This is usually impairments or other non-operational gains and losses. Below that is pre-tax income, then their taxes. And the bottom line of the income statement is their net income. And they had a big negative in 2020, positive in prior years. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. Operating cash flow is a better indicator of a company's financial health than net income, because net income is your accounting profit and loss. It's not actual cash. And then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. It was negative in 2017. They had their biggest CapEx year that year, so they invested a lot in their company and had negative $22 million of free cash flow. But they did have a strong positive in 2018 and 19. Of course, they had a negative in 2020. The company added about $93 million of debt in 2020. They did pay down $80 million in 2019. They added about $165 million of debt in 2017. Let's look at the capital structure. $24 million of equity, $1.9 billion of debt. So they're 99% debt, 1% equity. Their WACC is 11.67%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $963 million. We divide that by 63 million shares. And we get a calculated stock price of $15.20. They're trading at $14.07, so they're trading at a 7% discount. It's a buy according to the model. Simply Wall Street values the company at $2.19, so they're saying it's really overvalued. I think there's about a 50% chance of this company going bankrupt. If you think they're going bankrupt, the stock is worth nothing. But I'm assuming the other 50% in this model that they're not going to go bankrupt and they will generate positive free cash flow in 2023. They could generate it in 2022, but I'm being more conservative with my model. So if they don't go bankrupt, I definitely think this stock could go way higher. This is the stock price the last 5 years. It was over $50 at one point for a while. Then it seems like it's pretty much been on a decline since then, dropping little by little every few months. It's at a really low point. Even if the company did go bankrupt, you could still make money. There could be a run-up on this stock. But if they don't go bankrupt, I don't see why they can't get back up to $50 a share again. Last month, the company was able to secure a $250 million bond sale. And it seems like the company is able to get $1 billion of funding if they wanted to. So there's a lot of people that are willing to invest in this company because movie theaters are an important part of our lives. They're definitely not going away. The only question is what companies will be around to show those movie theaters. If you think Cineplex will be around, then this is a good investment. You just have to hold till the stock goes back up. And it seems like the company is starting to reopen theaters. Just last month, they were able to have up to 100 people in their theaters. They have a really high beta, 3.23, so the stock is really volatile. It moves more than 3 times the market. The stock has gone down 52% in the past 52 weeks, while the S&P 500 went up 40%. The 52-week low was 432, the high was 31. The stock is trading well above its 50-day and 200-day moving average. About 1.2 to 1.6 million shares are traded each day on this stock. Of the 63 million shares outstanding, 57 million are on float, 29% are held by institutions, and a little over 4% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd be at $5,900 today. That's a 5% annual loss. The biggest shareholder is Sandgrove at 9.8%, then FMR, Fidelity, Dimensional Fund, and TD. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, you look to the price to sales ratio. Price to sales is stock price over sales per share. They're at 2.1. So investors are paying $2.10 for $1 revenue. That's a really good price to sales ratio. Price to book is stock price over book value per share. They're at 36.8. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have 24 million of equity, negative 700 million of tangible equity, because they have 720 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They could only cover 40% of their current liabilities with their current assets. Their current assets as of their last published balance sheet is 16 million of cash, 118 million of receivables, and 21 million of inventory. They did that $250 million bond sale recently, so they have more cash on their balance sheet than the $16 million. The company seems to be undercapitalized. This does not include the bond sale, but they did have negative $189 million of free cash flow, negative $241 million of working capital, so they're short over $400 million. But they could have positive free cash flow in 2021, or their negative in 2021 might not be as bad as 2020. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 5 other companies in the same industry as Cineplex, and if Cineplex has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they do have a better PE than average because the average is so terrible. They're doing really well on price to sales. They're worse than average in price to book. They have one of the worst current ratios, terrible ROE. They're almost all debt, and they're a really small company, under 1 billion market cap. So to summarize, I have them trading at a 7% discount, but this stock could go way higher because people are itching to get out and go to the movies. That's something people enjoy, families enjoy. I don't think many people are itching to go on cruises. Some are, but I don't think that many. Of course, any company can go bankrupt. This company has a decent chance of going bankrupt. But if they do not go bankrupt, I think this is a great investment because the stock price is so low right now. I rank their free cash flows 1 out of 10, their revenue 1 out of 10, and their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.